historical market panics, they usually operate a lot like heavy machinery.
Right, yeah.
There's this sheer physical weight to global uncertainty. I mean, it takes a really long time for a sell-off to slow down and even longer for confidence to speed back up.
Yeah, fear has this tangible momentum to it. Once global logistics are threatened, that fear just tends to compound on itself, day after day.
Right. But today, that momentum hit an absolute brick wall. I mean, it turned completely around and accelerated in the opposite direction. So, welcome to Market Recap. I'm Daniel.
And I'm Mira.
Today is Tuesday, April 14th, 2026, and we are unpacking a massive, widespread relief rally.
A huge rally.
Yeah, and to figure out what just happened, we're pulling from a pretty deep stack of sources today. We're looking at raw pricing data across equities and commodities, the International Monetary Fund's latest World Economic Outlook, a fresh batch of corporate earnings, and some breaking diplomatic reports out of the Middle East.
And, the result of all those inputs colliding, the S&P 500 rose nearly 1.2% today. It was closing in on that historic 7,000 mark.
Unbelievable.
Yeah. The NASDAQ surged almost 2%, and the Dow gained roughly 0.2%. We're really looking at a very specific sequence of drivers today. Surprisingly cool wholesale inflation data, a massive divergence in banking earnings, and, like you mentioned, geopolitical news that completely flipped the script.
We are going to unpack the mechanics of how and why all that happened, but before we get into the weeds, we do need to issue our mandatory reminder.
Right, always important.
Yeah. This deep dive is designed strictly for market context and discussion. We are just here to help you understand the baseline environment you are operating against. This is not personal investment advice or, an investment recommendation.
Exactly. We're here to decode the machinery of the market, not tell you what to buy or sell.
So let's establish our foundation. Session 1. What set the stage before the U.S. session?
Well, to understand today's melt-up, we actually have to rewind slightly to the narrative the market inherited from yesterday.
The weekend talks.
Right. Over the weekend, there were these grueling 21-hour ceasefire talks between the U.S. and Iran taking place in Pakistan. And, well, those talks collapsed. They ended without a lasting agreement.
And Asian markets woke up to that reality and just sold off hard.
Yeah, the collapse initially spooked global markets entirely. I mean, it destroyed any immediate hope for a diplomatic off-ramp, and it sent Brent crude oil spiking aggressively past $100 a barrel.
Because the underlying fear was a total prolonged disruption of global energy logistics, right?
Exactly. But then, fast forward to Monday morning, and the U.S. administration made a really critical clarification. They announced a blockade of Iranian ports, but they explicitly defined it as a limited blockade.
That word limited is doing a lot of heavy lifting there.
It really is. The administration specifically preserved freedom of navigation for other commercial ships in the wider Strait of Hormuz.
Which is obviously the crucial artery for global energy. But Iran immediately retaliated with threats against all ports in the Persian Gulf and the Gulf of Oman. So, heading into today, Tuesday, the market had this incredibly tense floor placed under oil prices.
Yeah, very tense.
So walk me through how the market digested that heading into today's open. Because, the initial drop over the weekend followed by today's rebound, it just felt like absolute whiplash.
It did, but the whiplash mathematically makes sense if you look at how algorithmic trading models process news feeds. When the weekend talks collapsed, the algorithms instantly priced in the textbook risk premium for worst-case scenario.
They just assumed the worst immediately.
Right. To a quantitative machine, a collapsed negotiation plus a blockade headline equals basically a 100% probability of a total straight closure. They do not do nuance well.
No, they don't.
They apply a generic maximum pain discount to global equities. The logic chain is incredibly rigid, it goes. Total closure means an energy shock. An energy shock means sticky inflation. And sticky inflation means the Federal Reserve cannot cut interest rates.
See, I have to challenge the textbook models on this because I think this is a perfect example of what I call geopolitics as human game theory.
Okay, how so?
The algorithms got it wrong because they treat geopolitical events like random natural disasters. They react to a blockade the same way they'd react to an earthquake.
As a sudden, unpredictable tail risk shock, a binary event.
Exactly that. But geopolitics is not a random shock. It is sequential human game theory. When practitioners, actual human investors, looked at that U.S. announcement on Monday morning, they didn't see an earthquake. They saw a calculated poker move.
Because of the word limited.
Yes. The U.S. specifically used the word limited for the blockade. They deliberately left the wider strait open. That is a strategic signal, a way to apply pressure while leaving a door open for de-escalation. The algorithms just dump stocks blindly at the first scary headline over the weekend, violently overreacting to the downside.
Well, I will concede the limits of academic models there. Mathematical models fundamentally struggle to price in sequential human game theory.
They just can't do it.
Right. They're designed to assess the binary presence of risk, not the developing logic of a political chessboard. So the algorithms priced in a permanently closed strait, but human practitioners realized the diplomatic door was still wedged open.
And that tense but surprisingly stabilized energy backdrop is exactly what investors woke up to this morning. So, to wrap up this segment, we had a market that had already priced in the apocalypse over the weekend, only to realize the apocalypse was, well, on hold.
For now, at least.
Right. We'll take a brief pause here. When we reopen, we'll dive into how the opening bell in New York completely poured gasoline on this setup.
Sounds good. Okay, let's transition into the main event. Session 2. What moved markets during U.S. trading hours today?
We actually had 3 distinct macro triggers today that essentially acted as a step-by-step ladder for the indexes, starting right at 8:30 a.m. Eastern Time.
The PPI did.
Yes. At 8:30 a.m. Eastern, the U.S. Producer Price Index, the PPI for final demand, dropped. And just for context, this measures wholesale inflation, which is what companies pay for goods before they pass those costs on to consumers.
And the numbers were shocking.
Very. It printed at just 0.5% month over month. That is less than half of the 1.2% consensus forecast. Furthermore, core PPI, which strips out the really volatile food and energy costs, rose just 0.1%.
I really cannot overstate how massive that delta is. I mean, the expected wholesale inflation number was over 1%, and it came in at less than half of that.
It completely changed the mood. It did. The entire dark cloud hanging over the market was the fear that the recent energy spikes from the Strait of Hormuz disruption were going to, bleed into runaway wholesale inflation. This morning's print essentially erased that immediate fear.
It did.
In fact, we saw the Treasury yield curve actually uninvert, sending the 10-year yield down to 4.15%.
Let's quickly explain the mechanism behind that yield curve shift, because it's crucial. Usually an investor demands more interest to lock their money away for 10 years than for 2 months, because obviously more can go wrong in a decade.
Right. Time is risk.
Exactly. When that relationship flips, when the curve inverts, it means the market is terrified of near-term economic shocks. The fact that the cool inflation data caused the curve to uninvert today means traders are finally breathing a sigh of relief about the immediate future.
It essentially gave traders permission to buy again.
It really did. And if we connect this to the fundamental valuation of tech stocks, this is the discounted cash flow model at work.
Okay, walk us through that.
Think of the discounted cash flow model like a financial seesaw. On one side, you have the projected future profits of a company. On the other side, you have the current interest rate.
Okay.
When wholesale inflation comes in cold, the market assumes the Federal Reserve will lower interest rates. As that interest rate side of the seesaw goes down, the perceived present value of those future tech profits naturally goes up.
Ah, I see.
Yeah, so that 8:30 a.m. data drop mathematically justified the NASDAQ surging nearly 2% today.
But the euphoria was momentarily checked, right? At 9 a.m. Eastern Time, we got a dose of institutional sobriety.
We did. The International Monetary Fund released its April 2026 World Economic Outlook. They cut 2026 global growth to 3.1%, directly citing the Middle East conflict.
And they had a warning about oil, too.
Yeah, they explicitly warned of a global recession if oil averages $110 a barrel. And, cutting global growth to 3.1% might sound like a minor decimal adjustment, but on a planetary scale, tenths of a percent represent hundreds of billions of dollars in lost economic activity.
Yeah, that IMF report acted like a heavy anchor. It kept Treasury yields from falling completely through the floor. But that caution didn't last very long, because at 11:50 a.m. Eastern Time, we hit the definitive intraday turning point.
This was the major catalyst for the melt-up. President Trump gave an interview to the New York Post stating that U.S.-Iran talks could resume in Pakistan over the next 2 days.
The market reaction was instantaneous and violent. I mean, Brent crude instantly retreated to $92 a barrel. Equities initiated a massive, unadulterated rally. The S&P erased all of its recent war-related losses in a single afternoon.
The market basically priced in the resolution before it even happened. Lower inflation from the morning, plus a diplomatic off-ramp in the afternoon, equals a bright green light for risk assets.
Okay, I have to step in here and apply some friction. This is where I think the market is really suffering from the illusion of instant information diffusion.
What do you mean by that? The headline hit the terminal and the assets repriced. I mean, that is textbook price discovery.
It's paper price discovery, but it is entirely divorced from physical reality.
How so?
Yes, the algorithms and the fast money instantly bought the NASDAQ and sold crude oil at 11:50 a.m. But think about the actual physical logistics. There are still lost naval mines floating in the Strait of Hormuz. You cannot clear a major global shipping choke point in an afternoon just because a positive diplomatic headline hit a Bloomberg terminal.
Ah, so you are arguing the market is confusing diplomatic intent with physical logistics.
Exactly. It takes more than one trading day for a market to truly digest the physical reality on the ground. The initial algorithmic panic over the weekend was wrong, but today's instant euphoric relief rally might also be a massive overcorrection.
Because the physical risk is still there.
Right. You do not resolve a structural energy bottleneck with a single newspaper interview. The actual risk to ships is still physically there.
You know, that is a very fair critique. I have to admit that true price discovery is inherently messy, and it is heavily bounded by human emotion. In today's case, an overwhelming wave of relief.
People just wanted it to be over.
Yeah, exactly. The market priced the diplomatic intent as a mathematical certainty, entirely ignoring the fact that the actual physical clearing of the strait will take much longer than a 5-minute stock chart implies.
Right. So, to wrap up our second session, we had a powerful combination of surprisingly cool inflation data and a massive injection of diplomatic hope sparking this broad index rally. But true price discovery takes time.
It does.
Let's take a quick pause here. When we shift our focus, we need to look under the hood of those rising indexes because there were some massive corporate tectonic plates shifting today.
All right, let's bring it down to the company level. Session 3, corporate events recap and what to watch next.
So before the U.S. trading hours even began, we saw a major divergence in the banking sector. We had a mixed bag of financial earnings that really painted a picture of the current dual-speed economy.
Yeah, it started at 7 a.m. Eastern Time. Wells Fargo missed their earnings per share estimates, coming in at $1.56 versus the expected $1.60. Their shares dropped 5.7%.
Which is a pretty significant hit.
It is. This highlights the immense pressure on traditional lending margins right now. In a high-rate, highly volatile macroeconomic environment, borrowing costs are high, and traditional lending becomes a very tough business.
But at that exact same time, 7 a.m. Eastern, JP Morgan reported, and they beat expectations with $16.5 billion in profit.
But their stock didn't pop.
No, it didn't, because their executives issued severe warnings about macroeconomic risks and the incoming Basel III capital rules. So despite the massive profit beat, their shares actually dipped 0.8%.
We should probably quickly define Basel III for everyone.
Good idea. These are international regulatory frameworks that essentially force banks to hold more actual cash in reserve against their riskier assets. The more cash a bank has to lock in a vault, the less it can lend out to generate profit. So JP Morgan is making money now, but they are warning the street that their regulatory ceiling is lowering.
Right. And then look at what happened just a bit later in the pre-market. At 7:30 a.m. Eastern, BlackRock reported $130 billion in net inflows. Their shares went up 3.0%. And at 8 a.m. Eastern, Citigroup absolutely crushed their estimates, reporting a $3.06 earnings per share. Their shares jumped 2.6% to their highest level since late 2008.
I mean, think about that spread. Wells Fargo is down nearly 6%, and Citi is hitting highs we haven't seen since the great financial crisis. This is the hopeful edge for investors.
The divergence in performance, you mean?
Yes. If the market were perfectly efficient and monolithic, every bank would move together based on whatever the Federal Reserve or inflation was doing. But this wide divergence proves that active stock picking is absolutely crucial right now.
You really have to do your homework.
Exactly. The market is clearly rewarding trading in capital markets, which Citi and BlackRock excel at, while actively punishing traditional interest rate dependent lending operations. It shows you that in a volatile regime, you cannot just buy the sector, you have to look under the hood.
Speaking of looking under the hood, the corporate mega deals today were staggering, specifically around the AI infrastructure supercycle.
Oh, absolutely. At 8:45 a.m. Eastern Time, before the market opened, JP Morgan put out a note massively hiking their price target on Bloom Energy from $166 to $231.
And the catalyst for that hike was Bloom securing a massive 2.8 gigawatt power deal with Oracle.
Which is just an insane amount of power.
It is. Bloom shares skyrocketed 24% today, and Oracle rose nearly 4.8%. If we connect this to the broader structural narrative, this is the pure manifestation of the $635 billion plus AI capital expenditure and electrification supercycle.
It's all about the grid.
Right, a 2.8 gigawatt power deal isn't just a corporate partnership. It is the electrical equivalent of powering multiple major cities. You cannot run next-generation autonomous AI data centers without absolutely massive, dedicated grid infrastructure. The market is violently pricing in the winners of the grid build-out.
It really is the heavy machinery of the AI boom. But, the massive deals weren't just on the ground, they were in orbit. Yeah. At 9:17 a.m. Eastern Time, early in the market session, Amazon announced an $11.57 billion acquisition of the satellite company Globalstar. Amazon shares lifted 3.83% on the news. They are signaling massive, aggressive aerospace capital expenditures to build out their space internet network.
It is quite literally a space grab.
Yeah.
And the deal-making kept going. Intraday, right around 10 a.m. Eastern, reports broke that United Airlines CEO Scott Kirby pitched a potential merger with American Airlines directly to the White House.
Which sent American Airlines surging 8% and United up 2%. Honestly, it was such an explosive day for the markets that United Airlines is pitching a merger with American Airlines just to ensure there are enough flights to take this rally to the moon.
That's entirely fitting for today.
I mean, between Amazon buying up space satellites and AI energy stocks skyrocketing, the only thing actually coming back down to earth today was the price of crude oil. Congratulations on surviving the volatility and riding the massive relief rally. Everyone enjoy your victory lap.
It really was a breathless session, but of course, the market never actually sleeps. So what should we be watching over the next 24 hours?
We've got a packed radar. First, keep an eye on French President Emmanuel Macron. He is scheduled to give a major speech on digital assets and the European financial architecture.
Second, and arguably most important for the immediate macro picture, we are waiting for potential official confirmation of the venue and schedule for round 2 of those U.S.-Iran talks, which will likely take place in Islamabad.
Third, the International Energy Agency, the IEA, is releasing its monthly oil market report. And we don't just need their high-level summary. We need to see their hard data detailing the direct, volumetric supply impacts of the Strait of Hormuz blockade so far.
Right, the actual barrels off the market. Fourth, the Q1 bank earnings parade continues. We are looking specifically for Bank of America and Morgan Stanley. We need to see if that massive divergence between capital market trading and traditional lending holds up.
And finally, number 5, we will be watching for commentary from Federal Reserve officials reacting to today's cooler-than-expected PPI data.
Will they acknowledge the cooling wholesale inflation and hint at rate cuts?
Or remain cautious about the sticky energy risks still lingering in the Middle East? Which really brings us to the core tension of this entire rally. Today, the market priced in an absolute Goldilocks scenario.
It really did. We received cooling inflation data, and we received a signal of easing geopolitical tensions. That is the perfect runway for a tech-led melt-up.
But I want to leave you with this final puzzle to mull over. We saw the algorithms and the fast money rush back into equities today, assuming the storm has entirely passed. But think about the physical realities we discuss.
The bottlenecks.
Yeah, there are still naval mines physically choking off global energy logistics in the Strait of Hormuz. And on the tech side, this massive AI capital expenditure spending spree we saw rewarded today is simultaneously pulling forward an enormous projected deficit in global copper markets.
You can't wire a 2.8 gigawatt data center without thousands of tons of copper.
Exactly. So the provocative question we have to ask is this. Are investors currently confusing a temporary, highly visible diplomatic headline with the actual resolution of deep physical world structural constraints?
Are we trading paper reality while ignoring physical reality? It is the ultimate question for this market regime.
It really is. Thank you so much for joining us for this deep dive.
We love unpacking these complexities with you.
Drop a comment below and tell us if you think today's relief rally is the start of a new, sustained light up or just a temporary sugar high masking deeper structural issues.